Welcome to Cat Eye U.S. stock. We watch markets with calm focus and sharp instincts. Wednesday, March 11th, 2026. Here's the vibe. Oil ripped, energy led, and the major indexes barely moved. Mixed, cautious, a little tense. The real story wasn't a rally, it was rotation. Money leaned into what wins with higher oil and what can outrun the macro, while a big chunk of the market just sat it out. On the S&P 500 Heatmap, this looked totally split and choppy, with a mild red tilt overall. The green wasn't broad, it clustered. Energy was the obvious bright spot, and semis showed some selective strength. Meanwhile, a lot of consumer and financial space stayed red, so the index looked calm, but the internals, way louder. That heat map told a pretty specific money flow story. Traders leaned into energy as an inflation and geopolitics hedge, cash flow certainty when crude stays elevated. At the same time, they still paid up for selective semis tied to AI infrastructure. But the broader market refused to follow. Consumer and financial names traded like higher fuel costs and macro uncertainty could pinch demand and risk appetite. Rotation, not full commitment. So today's real context? A standoff. The index is held up, but only because leadership narrowed into two buckets, things that benefit from higher oil and things that can outgrow the macro. It didn't resolve the tension, oil shock and inflation risk on one side, AI durability on the other, and the most notable feature, dispersion. This was a positioning day. One story floating around desks today, pure chatter, not confirmed here, was talk of a large, coordinated, emergency strategic reserve release after the crude spike and Middle East supply risk headlines. The key point is how markets treated it. It added volatility to crude. But equities still leaned into energy as the cleaner long. No broad risk on, just a targeted hedge. Is the global energy heart about to stop beating? And can a record 400 million barrels of oil actually save your portfolio? It's March 11th, 2026, and we're watching near total paralysis in one of the world's most critical trade arteries. The Strait of Hormuz isn't just dangerous, it's effectively closed. Just hours ago, the Thai-flagged Mayuri Nuri was hit by projectiles and left burning, a brutal signal to every commercial captain that this route is now a maritime graveyard. To prevent a global economic cardiac arrest, the IEA just pulled the ultimate emergency cord. In a unanimous historic move, they authorized the release of 400 million barrels of strategic reserves. This isn't just a policy shift, it's a wartime-style intervention to keep oil from a permanent moonshot past $120. But the physical danger is only half the story. On the front lines, U.S. CENTCOM confirmed they neutralized 16 Iranian mine-laying vessels in just the last 24 hours. The Navy is clearing the water, but the markets aren't waiting for the smoke to clear. We're seeing a full-on insurance meltdown. War risk premiums have spiked 30 times. To put that in perspective, it now costs about $2.5 million in insurance alone just to send one tanker through. For most of the global fleet, that math is officially broken. Saudi Arabia is trying to triage the wound, ramping its Petroline pipeline toward its 7 million barrels per day capacity to reach the Red Sea. But do the math. Even at full tilt, that still leaves a massive 13 million barrel per day hole in the global market. We're watching the energy map of the world being redrawn in real time in blood and oil. Is this a temporary spike, or the new reality for 2026? Stay locked to Cat Eye U.S. markets as we track every move in this escalating crisis. Oracle ORCL was the cleanest single stock statement of the day. Shares jumped just over 9% after a fiscal Q3 earnings and revenue beat with strong cloud and AI growth. Management also raised its long-term revenue outlook, including an outlook lift for fiscal 2027. In a rotation tape, Oracle mattered because it looked like a high-signal AI infrastructure monetization proof point, real revenue, not just hype. ExxonMobil, EXXON, ticker XOM, climbed just over 2% in an oil-driven move as crude stayed elevated on geopolitical supply risk headlines. This was one of the clearest leadership tells of the day, choppy index. But energy names kept catching a steady bid. It reinforced that the market was paying for inflation and geopolitical hedges, not chasing broad growth beta. Chevron, CVX, added just under 3%, with the whole energy complex bid alongside higher crude and a persistent geopolitics premium. The point here isn't stock-specific drama, it's confirmation of sector-level capital flowing into energy. That broad bid across the group is what made today feel like rotation, while the rest of the market stayed uneven. Micron, MU rose almost 4% and really defined the selective semis part of the story. The setup tied to AI memory and HBM enthusiasm, plus solid visibility into data center demand. Micron matters because it's more cyclical than software, so when it's leading on a choppy day, it reads as targeted risk-taking inside tech, not a broad risk-on surge. NVIDIA, NVDA held a gain up just under 1%, with semis staying firm even as the broader tape stayed choppy. The recap frames NVIDIA as the sentiment governor for AI beta. Staying green on a red tilt day says traders aren't abandoning the AI complex, they're just sizing that exposure more carefully. Amazon, AMZN, slipped just under 1% as consumer discretionary stayed under pressure from that higher oil equals energy tax worry on the consumer. And that's why today never felt like clean risk on. A huge index weight was a drag, reinforcing that the bid was selective. Energy and certain AI names, not the consumer-facing parts of the tape. Near term, the swing factor is still crude and Middle East headlines because that's what keeps inflation expectations in play. On deck next week, Empire State Manufacturing on Monday, March 16th, pending home sales Tuesday at 10 a.m. Eastern, then the big pivot, PPI plus the FOMC rate decision, projections, and press conference on Wednesday, March 18th. Heading into that, the big question is simple: does leadership broaden or stay narrow and defensive tilted? Wrap it up like this. The index didn't give you the story today. Rotation did. Energy strength versus consumer and financial softness, with selective AI and semis holding key levels. Going into the next session, keep it simple, watch breadth, watch crude, and watch whether leadership finally expands beyond the same narrow pockets. Thank you for watching Cat Eye U.S. stock. Stay curious, stay calm, and we'll see you next time.